22.8%, lower than the same period last year. What does this all really mean? On the one hand, the annual growth in credit hints at the resilience in the private sector, and on the other, the monthly slowdown in lending and the sharp fall in reserves raises questions about liquidity and external pressures. And of course, none of this is happening in isolation. There's global inflation pressures, there's supply chain disruptions, as well as shifting regional trade dynamics that could very well be shaping these trends. Sanelus B, our economist, chimes in and he fills us in on the implications of this particular development. 3 minutes after 2, you're watching Nedbank Business Watch.
Our business stories after this.
Digital helps you make cross-border payments. Human gives you global specialists. Digital allows you to apply for a loan anytime, anywhere. Human connects you to credit experts. Digital puts you in control of your money, while Human connects you to wealth advisors. Digital allows you to freeze, unfreeze, cancel, and reorder your card. Human gives you that personal touch. Digital when you want it. Human when you need it. Get the complete private banking experience with Nedbank Private Clients.
Welcome back. You are still watching Nedbank Business Watch. Now, moving on to the program, let's have a look at our business stories this afternoon.
We start with the SMEs, where small and medium enterprise owners have been trained on how to leverage the digital arena. This is a means to help them monetize their businesses and expand into regional markets. This is a training that was conducted under the Global Cooperation and Training Framework Conference hosted by the Taiwan and the United States Embassy in collaboration with the Ministry of Commerce, Industry and Trade and the Ministry of Information, Communications and Technology, an event that is currently ongoing in Eswatini.
Digital technology offers new ways for small businesses to reach markets, improve productivity and participate in the global economy. Knowledge-sharing platforms like GCTF help countries learn from each other's experiences in digital transformation and innovation policy.
The ambassador of Taiwan pledges unwavering support for local micro, small and medium enterprises in the digital arena.
Our primary goal is to help create more jobs and more opportunities for the youth of Eswatini. Looking at the experts in this room, I know the next 2 days will be incredibly productive. In today's AI-driven economy, Taiwan holds a unique position. If Silicon Valley is the brain of the innovation, and then Taiwan is the backbone that makes it happen. We are the heart of global high-tech manufacturing. Our strength isn't just in making one part. It's in our entire ecosystem. From the advanced chip powering your phones to the servers running the cloud and the language models, and even the drones and the satellites of the future, Taiwan is a key player in almost every emerging industry.
U.S. Charge Affairs encourages young entrepreneurs to harness digital platforms to grow and monetize their businesses.
AI and emerging technologies are going to make our lives easier, more efficient, and more convenient. Some examples include ride shares that get you to your meetings and events on time, grocery store or pharmacy deliveries that get you things you need when you need it, and online banking that saves you standing in line at the ATM on, the first of the month. The United States and Taiwan are having the same conversations that Eswatini is having now. Customers aren't confident in a product they can't hold. They're hesitant to share their payment information. Additionally, Not everyone has access to the internet, which raises concerns about investing in digital solutions that might exclude some people. This is part of the transition. It's not something that changes overnight. It's a process, and there's a role for everyone here. Eswatini's government is leading through digital literacy programs and providing government services such as the Government in Your Hand initiative led by the Ministry of ICT. However, most of the changes will not come from government action or top-down regulations. No law can require consumers to trust the quality of online products or mandate that businesses keep their online information, such as hours and locations, up to date. Likewise, no regulation can compel individuals to leave positive reviews after a good experience at a business. Meaningful progress in the online environment will depend on the voluntary actions of businesses alike.
Workshop participants shared their insights and experiences.
This workshop is very important to me as a young digital entrepreneur. It will help me solve challenges I currently have as I go about my journey with regards to how I can use AI to basically enable me to do more, how I can integrate payments into the solutions I'm building.
I work with a lot of young people who are in business, and it's important for them to understand digital entrepreneurship because we know that we're living in a landlocked country, so it's important to grow access to different markets internationally, and that can be done digitally.
The Minister for Commerce, Industry and Trade says the program is not new in the country, as past workshops were held in 2021 and 2024, focusing on women empowerment milestones, challenges and celebrating International Women's Day. Honorable Manqoba Khumalo says digital technology offers new ways for small businesses to reach markets, improve productivity and participate in global economy. Reporting, Nelson Dlangamandla, Vuminkosi Nzinisa, Ezulwini.
The Minister for Finance, Honorable New Weikenberg, has urged the nation, especially the youth, to invest in financial literacy to avoid debt traps, plan for emergencies, grow ideas into businesses, as well as build a stable and independent life. The minister was speaking at the Central Bank of Eswatini complex in Ezulwini when launching the Global Money Week under the theme Smart Money Talks.
This week is dedicated to one important idea: empowering people, especially young people, to make smart, informed, and responsible decisions around money. Money is something that we all interact with every day. We earn it, we spend it, we save it, and oftentimes we borrow it. Yet for many people, money is not openly, transparently, and holistically discussed. For young people, these conversations are especially important. The decisions you make today about saving, spending, borrowing, and investing will shape your future opportunities. Financial literacy helps you to avoid debt traps, helps you to plan for emergencies, helps you to grow your ideas into businesses, and helps to build a stable and independent life for yourself. As government, we recognize that access to financial services alone is not enough. People must also understand how to use those services wisely. That is why we continue to strengthen policies and promote financial education, consumer protection, inclusion, so that financial products work for the people and not against the people. I encourage you, the youth, to be curious and proactive. Ask questions about interest, budgeting, digital payments, savings, borrowings, and insurance. Do not be afraid to ask and seek advice and to learn continually. Smart money choices are not about how much you earn, it's about how well you manage what you have. Global Money Week is not just an event, it is a call to action. Let us ensure that the conversations we start this week continue in our homes and in our schools and in our communities. Let us build a generation that's confident, informed, and financially resilient.
Siboniseni Zulu Simelane Masego is the new chief executive of Eswatini Competition Commission. She was announced by the Minister for Commerce, Industry and Trade, Mangoba Khumalo, during a press briefing at the Real Villas in Eswatini. She takes over from Muzi Dlamini, who led the commission for 5 years.
I'm therefore excited today that Ms. Siboniseni Zulu Simelane Masego is our new CEO that we are introducing to the nation today. She is a very experienced professional in the competition space, having worked for the Eswatini Competition Commission and thereafter transitioned to work at the COMESA Competition Commission before returning home in 2024 to be the Director of Competition and Consumer Protection, reporting to the outgoing CEO. We've had a very strong field of people that were looking to be successful for this particular role.
I would like to assure you that the Competition Commission will support the national development goals to support we are not a hindrance to business, but we facilitate businesses and support umbuso wengonyama.
And that is your business brief this afternoon. After the break, we speak to in-house economist Daniel Sylvia. Stay with us. Welcome back to the program. The Central Bank of Eswatini has released its January to February 2026 statistical report, and private sector credit reached 22.1 billion emalangeni at the end of January, and that is signaling a down by 1.4% month-on-month, but up 5.3% year-on-year. The government's net financial position improved, with net claims on government dropping to 885.7 million emalangeni. Provisional gross official reserves fell to 9.5 billion emalangeni in February, a 15.3% month-on-month decline and a 22.8% drop year-on-year. Now, these figures reflect a mixed economic performance. Annual credit growth shows some private sector resilience, but the monthly contradiction and significant reserve decline signals potential liquidity pressures. Could global turmoil, including inflationary pressures, supply chain disruptions, and regional trade fluctuations likely to have impacted these trends, contributing to slower monthly credit expansion and lower reserves? Economist Sanela Sbia joins us to unpack these latest numbers. Sanela, thank you so much for joining us. I suppose the bigger picture is exactly that last question on the intro to our conversation, which is, could inflationary pressures or the global uncertainties that we continue to experience have an effect on these numbers?
Thank you, Mr. Ngumalo. Good afternoon to the viewers. So yes, inadvertently, this is actually going to have impact on the numbers, going forward. But what we are seeing with these numbers is, there has been this cautiousness already coming through in January and February, even before we saw this new huge supply chain disruption. But at the end of that, remember at the back of that, there was the Venezuela story, and there's always been turmoil in the Middle Middle East, and the signals were there. So you do expect to then start seeing the credit markets contracting a bit, and also there are those issues to do with the fact that we're coming in from the first month of the year, which are usually for households. Most of the funding there goes towards towards school fees and all of those issues, and then there is the lackluster performance of the miners, more especially the coal miners. And if you look at that number there, they accounted for about 10% of the decline. So you could see that it had those sector specific, and the global currencies were already starting to build up on those specific sectors, and now we expect it to remain magnified if the global turmoil continues and we see those inflation fears coming back into the consumers and the investors' risk matrix coming down very hard and rapidly going forward. So we should expect to see a bit of a dip dampening on the credit side of things, but you would expect that coming out of February and the school fees period, you would then expect to see households taking up a bit of that credit. But it's also just a two-sided story, that if we are seeing the miners not performing very well, then there are those retrenchments that one would then expect to see, and that tends to also affect the ability for households to borrow. And then going forward, what we are experiencing right now is really just heightening that risk matrix and that risk sentiment evaluation.
Yeah, of course. And I think you're alluding to the borrowing appetite in the economy beginning to cool. I was just really trying to decipher the term that you used there. I think you said dumping, and I'm really trying to understand, is that synonymous to the borrowing appetite cooling in the economy?
Yes, it's just dampening a bit. It's cooling. Yeah, let's use cooling. Cooling is a better word.
Fair. I just wanted to make sure I'm understanding you correctly. Let's look at sectoral borrowing now, because when credit slows even slightly, it often at least tells a deeper story. Which sectors do you suspect are driving this trend? Households tightening their belts, or businesses becoming more cautious about investments?
So I would think it's a mix of both. Remember, we're coming into this period post the COVID pandemic with households already on a stricter, facing huge cost of living pressures, and then now what you have is that mineral downward spiral, more especially within the coal and the quarry in the international markets, and we already saw impacts of that later on in the year 2025 on the Eswatini economy. Now it's trickling into that space, because when you look at that sectoral breakdown, we're seeing that the tourism, the mining sector there is amongst the ones that were actually leading in terms of the credit, the declines in credit. And then there's also the tourism sector there, which took about 10.6%. The mining sector declined 2.6%. Again, now that shows that we're still on that recovery mode where you expect, and these figures were showing in the inflation data that we kept on seeing later last year, with tourism remaining a bit dwarfed, and we knew that the miners were facing a bit of a story there. So it's a picture across the board, but largely driven by the tourism industry, and then also there is the mining space. The real estate, real estate really suffers when you're facing these huge cost of living pressures, because you do expect to build houses for a consumer that can afford to do so. So that's where we are seeing most of the declines coming through, Mr. Nguman.
Government's financial position on this, because the report is showing net claims on government declining to about 885 million emalangeni, and I suppose it is easy to conclude that this suggests an improved fiscal position. Is that the case, or perhaps it just something that we could call short-term financing dynamics. What is it really?
So what we need to understand, Ms. Ngumalo, is when we track, the government's position, it usually goes with what we call the SACCO receipts. There, when it comes in, there is an advance that gets paid, and that tends to temper off in terms of our overall government's net claims, because that 2 billion would have been paid entirely. And then what we saw again happening towards the end of last year, which is beginning to reverse right now, was the exchange rate actually worked in our favor in terms of our of our debt there, where government was somehow now paying a lot of its debts at a lower level. Yeah, so I think it would be a story of those two for me, Mr. Ngumalo. Number one is the flow in SACCO receipts. The last tranche that came in of SACCO receipts, I think it came in January or early February, and then the payment of that advance, which then would be reborrowed, so to put, and the exchange rate scenario there. So we've had a bit of two factors working in our favor as a kingdom there.
That figure there, 9.5 billion Malangeni gross official reserves, I suppose is going to raise the most eyebrows, because it seems like a very, very sharp decline in gross official reserves. It's a 15% drop in just 1 month, and that is quite significant, isn't it? How concerned should we be about the country's external buffer?
So when we look at the gross official reserves, Mr. Ngumalo, what we expect is to have 3 months of import cover, so that we do not affect the peg. And also, with what is happening globally, we've seen the exchange rate is now going back in the upper 16s against the dollar, and we're looking at the prices of Brent crude also going up, rapidly. So now that's a time where we really need to rethink and think through as a country whether we are going to have enough to ensure that we are able to survive this period, if indeed it does get elongated and we see the price of Brent crude oil staying above $80 for a longer period of time, and then that's going to start affecting our ability to import. And then also now the weakening exchange rate that is coming into play again makes it a bit difficult for us to import. So yeah, we are looking at that number with great concern at the moment, and we're hoping that if this war fizzles out very fast and we're able to get back to the upper 2-point-something months, and actually even the 3 months, that would be the most ideal picture. So it's a situation that is warranting serious consideration right now, given the global supply turmoils and the exchange rate fragility that we are seeing at the present moment.
Yeah, you just said right now, and then you said given the global turmoil. So, I suppose, of course, the global pressures that we continue to see, and very, very uncertain times in terms of the global turmoils. To what extent, really, might these global developments, the inflationary pressures, there is supply chain disruptions, there's regional trade shifts, to what extent might all these things be feeding into what we are seeing in these domestic numbers? It's not going to stop anytime soon if you really study what's going on around the world.
Yeah. So I think for us, what we're seeing is numbers for February, and this conflict started towards the last week of February. So what we're seeing is my take on this would be the impacts are going to show more so in the March numbers, but when you're coming into the March period with that 2.2 months of import cover, and you're already coming into that March period with a contraction in credit extended to the private sector, now that signals, a situation where we are as a country going to where we are as a country going to see even much more disruptions in the March numbers if the war continues. But from what we're hearing, what President Trump is saying is the war is almost over, but you are seeing continued strikes on vessels traversing the Strait of Hormuz. So it's just one of those situations that are all over the place. But yeah, definitely coming into March, if it persists right through the end of March, we might start seeing a bit of those shifts and movements, more especially once we start having to adjust, the March figure on pump prices. Now then we're going to start seeing a bit more of a contraction there, because then we'll start seeing inflation fears becoming a reality. So it's one of those issues that we are watching out for, Mr. Ngiman.
Yeah, when reserves fall and credit softens, questions inevitably rise about liquidity in the system. Do these figures suggest any risks to financial stability or the strength of the currency peg in the near term?
So the fact that we are on 2 months, when you look at the paper itself, the founding articles of the CMA, it does state that, what would have to be the ideal situation is 3%. So theoretically, we know that we are somewhat at a situation of discomfort if we're to fall below the 2 months import cover, say to 1 point something months. Now, that's a situation of discomfort theoretically, but it wouldn't be something that happens overnight. And by the time we come to it, you'd find that reserves have actually improved, because we've heard the central bank has started, just like all other central banks, is now beginning to buy gold in bars, not not holding currency as the reserve. So there are those considerations to be made as well in terms of the months of import cover, that what are our reserves composed of. Now that's going to be an issue as well. But in terms of the peg in itself, right now I do not see any reasons to worry. We are still within a comfortable band above 2%, but the ideal would be 3%, Mr. Ngumalo. So there isn't that much of some pressure there. But where I foresee a problem is with the upcoming months, where we're coming into a higher inflation, and would expect to then start seeing a reversal of these cut and pump prices that we saw, and that in itself would put consumers even under more strain. So that is why when we give insights on this issue is our best guess is if it lasts longer, then we are going to have a problem. But we're hopeful that it's going to end pretty soon, as that's what the White House is now beginning to say and talk around them. So it's a kind of a mixed bowl, but in terms of worrying, I wouldn't be worried right now about the reserves. We're still within a comfortable contingency to maintain the peg, but we are under strain. It's being strained a bit.
That's comforting, coming from an economist. But looking ahead now, let's say a couple of months ahead, from, let's say, policymakers as well as businesses, what indicators should they be looking to closely to gauge whether this is a temporary adjustment or, God forbid, a start of a broader economic slowdown?
So for me, Ngumalo, it would be that credit figure right there, because in terms of the reserves, we know that come April, when we receive the next tranche of payments from SACCO, that figure is going to improve, and I think we'll be back above the 2.5, which we've been comfortably sitting on over the last for the past year. So for me, it's that credit figure, Mr. Ngumalo. Remember, we are a nation that must ensure that we grow this economy above 6%. So now, when we're looking at a declining credit, not just household credit, Mr. Ngumalo, this seems to be cutting across all sectors. I mean, it's only the retail sectors that posted an upward. It's the retail and I think the tertiary sectors, a couple of sectors that have posted positive growth month on month, right? So what we need to do right now is to read through the signals. And unfortunately, right now, the signals are all over the place. and it does position the central bank in a bit of a tight position in terms of how now do you manage a situation of declining credit, because we would have assumed it would be a push towards, say, lowering the interest rate. But, there are some other areas that require structural intervention, like your tourism sector. Even if you lower the interest rates without, bringing tourists into the country, then that sector in itself remains, a bit subdued. But overall, what you'd want to do is to lower the interest rate. But right now, the signals are you can't do that. And then what else do we then need to do to get people spending in this very uncertain time? Right now, it's becoming an uncertain economic territory because you do not know, there isn't any certainty going forward. So that's where I'd be looking into that credit number and really just be watching what the trajectory of this war and what it means.
Thank you for your time. Uncertain times, an optimistic trajectory going forward, at least from an economist's point of view. From solutions on reserves to solutions from Nedbank Eswatini, a conversation that we had with Nosibusiso Dembe from Nedbank after the break.
Welcome back. You're still watching Nedbank Business Watch. Thank you for staying with us. Today I'm joined by Treasury Dealer at Nedbank Eswatini, Nosibusiso Dembe. She's here to talk about Nedbank Investment Solutions. A very good afternoon. Welcome back.
Thank you so much, Lulu. It's been a while.
Yeah. So today we're talking about investments. Why should we invest? Why is this topic important to talk about?
So, Lulu, the topic of investing is so important because it literally has the potential to transform lives and to secure futures. Yeah. And in an economy where financial stability is so crucial, it's not just a skill, it's really a necessity. Mm-hmm. At Nedbank, our slogan is to use our financial expertise to do good. And part of that is encouraging every Liswati to have a regular conversation about how to invest, how to save, and how to take money seriously.
All right. So the last time you were here, I think it was 3 months ago. I think it was May this year.
Yeah.
You took us through some of the investments solutions or options that Nedbank Eswatini offers. So what are we talking about today specifically?
So today we'll be unpacking some of the things to consider before saving and investing. Mm-hmm. But I think because it was so long ago when I was here, it's really important for us to just do a quick recap on some of the Nedbank products that we spoke about last time. Mm-hmm. So I'll start with our shorter term products, which is our savings account and our call account. These accounts have a variable interest rate, which means whenever there are changes in Eswatini Prime, whether upwards or downward, the interest rate on that account reprices, right? Then we have our notice deposit accounts, which are available in 32 days, 60 days, and 88 days notice. And that account also has a variable interest rate. It has funds that are available after the notice period has lapsed. So if you have a 32-day notice, for example, in order to withdraw those funds, you need to give 32 days notice, and then you'll receive them after 32 days. And then also it has a top-up option. So all the accounts I've mentioned all also have a top-up option. So if you are trying to accumulate funds, you can keep adding as and when you have money. Yeah. We also have our fixed deposit. That one has a fixed interest rate. The tenor is also fixed, and it has no top-up option. So you would ideally put a lump sum in a fixed deposit account. We have our floating rate term deposit accounts. A floating rate term deposit also has a fixed tenor, But the difference there is that the rate is floating and it's linked to Eswatini Prime. So when there are changes in Prime, the rate on that account also changes accordingly.
Okay.
And then lastly, we have our negotiable certificate of deposit, which is a new product to Nedbank, a first in the market product. And with that one, you have a fixed interest rate, you have a fixed tenor. You also can't top up, so you can't keep adding funds into that account, but it has a buyback option. So if you have a 12-month NCD, for example, because in short it's an NCD, and then before the 12-month lapses, you run into an issue where you need those funds, you can then sell that back, that instrument back to the bank and get the money in return for that.
Right. So Nozi, what does one need to consider, before making an investment decision? Because I know some of us, if not a lot of us, are in the dark. We've always heard people advising us to invest your money. Do I need to be financially stable? What do I need to consider?
So Lulu, there's a lot to consider when it comes to investing, but I think just for the purpose of this conversation, we'll be covering four things. The first is understanding your needs and what you are trying to achieve. The second is understanding the interest rate environment that you're currently in and what the expected interest rate environment is for the future.
Yeah.
The third is risk management. And then the last is diversification, which is a risk management technique.
So why is it important for a person to understand their needs? For instance, a pensioner, take us through the importance of understanding exactly why investment is important and what your needs are.
Okay, so it's very important to understand what your needs are and what you're trying to achieve, because that then leads you to understand what your investment strategy will be and what kind of product to select in order to achieve what you're trying to achieve. Yeah. So you mentioned a pensioner, and that's a good example, because let's say you have received a lump sum payout of sorts. It doesn't necessarily have to be a pensioner, but we'll use that as an example for now. So with a pensioner, you know that this is your last payout for probably the rest of your life. You need to make sure that it lasts for as long as possible, because it's the money you're going to have to live on from now on. Which means you do desire a good interest rate. You probably want to invest the lump sum and maybe receive interest payments, and live off the interest in order just to make sure you always have money available in your lump sum collection.
Okay.
But more importantly, you want to make sure that that money is kept safe. So you've spent the past 30, 40 years, however long you've been working, you've reached 60, you retired, you received your payout. This is money you've been saving for all those years. So basically you have been investing in your future. And you need to make sure that wherever you then invest those funds, you are comfortable that they are safe and you will always have access to them when you need them. So if you are a Nedbank client, for example, and you are a pensioner, would likely suggest to you a fixed deposit. Our fixed deposits pay interest either at maturity or monthly, quarterly, half-yearly, or yearly. So if you invest for 2 years, you can still get a yearly payment of interest. But mostly pensioners prefer our monthly payments, because then they can live off that interest for the rest of their lives, and the capital is secured.
Yeah, speaking of interest, let's talk about the interest rates. Why is it important to understand the interest rate environment and how it affects your investment decisions?
So that one is very crucial, Lulu, because interest rate environments directly affect what interest rates we will quote you as a bank. And you need to understand where you are right now and what the future interest rate environment might look like. And to just drive this point, I'll use the scenario of the time of COVID-19. So from the beginning up until just after COVID, as the economy was recovering. So in 2020, COVID-19 starts, and you might remember that during that time, the Monetary Policy Consultative Committee, which in short is MPCC, started to reduce interest rates to sort of cushion the impact on the consumer. And while the consumer was enjoying that, the investor was losing out on some interest due to that. And you then as an investor need to understand that and understand what the expectation is. So at the beginning of that cycle, economists were already projecting that we are in a downward interest rate cycle, right? So if you know that projection at the beginning, then when you make your investment, you know you're looking for something that has a fixed rate, so that you can fix the high rate before rates go down for whatever period. So it could be 12 months, we have 12-month fixed deposits, we have 24-month fixed deposits, and then you're stuck at that rate that we agreed at inception, even when interest rates are going down months later. And you need to understand that so you can pick the right product for yourself. Then we go into 2021. 2021 interest rates were muted. But muted at the low level that they ended 2020 at. And that happened throughout the year. So if you had invested at the beginning of the upward cycle in 2020, if you had invested in a fixed deposit for 2 years, during that 2021 period where interest rates are just at a consistent low level, you would have still been enjoying a high interest rate up until that fixed deposit matures. So you need to understand those things too. Then going into 2022, interest rates start to increase, right? Economists also did project that there would be an interest rate increase in 2022. So they start to increase up to the levels that we're at now. And if you are an investor at the time, so at the bottom of that curve, and you want to invest, you don't want to lock your funds in an instrument that has a fixed rate, because you are fixing a rate at the low levels that we're at. You would rather invest in an instrument that has a floating rate, so that as interest rates are increasing slowly, you are also moving up with the interest rate. So if the floating rate is linked to Eswatini Prime, whenever Prime increases, your deposit or your investment also increases. So it's important to understand what the interest rates look like at the time. And at Nedbank, we are always willing to share with our clients what our interest rate expectations are. You can contact your banker, you can contact us in Treasury directly, and we think it's important to share that information with our clients so that they can make wise investment decisions.
So that's one of the ways to effectively manage risks, because obviously, investing comes with risks.
Absolutely. That is one of the ways to manage interest rate risk. And our forecasts, by the way, I need to disclaim this, a forecast is just a forecast. We forecast what the expectation is based on what is happening right now. So there is a chance that in future that forecast will change, but it's important to at least know what's happening now when you have to make that decision.
All right, just before I let you go, we have a minute. Tell us more about diversification before you get into your contact details and how your clients can reach you.
Okay, so diversification is a form or a technique of risk management, because we know how important it is to manage risk, especially when we're talking about money. There is a balance between risk and reward that we have to manage, because not everything that glitters is gold. So we do have to manage that risk and reward, and diversification is a way of managing that. So if you have money, a lump sum payout that you want to invest somewhere, what would be ideal is, as you are exploring the universe of investments, you take portions of that money and you put them in different investment avenues. And in fact, it would be best for you to put them in investment avenues that have different risk portfolios or risk profiles even, so that if it happens that one of your riskier investments falls through, you at least have something to rely on going forward.
Okay, great. So how do your clients reach in case they have more questions more than this?
You can reach us at help desk. You can call our help desk on 3278-1999, or you can call us directly at Treasury on 3278-1145 or 3278-1325. We also have a group email address, treasury@nedbank.co.sz.
All right, thank you, Zibu. Well, there you have it. If you want to invest, do not hesitate to contact Nedbank Eswatini. Let's take a break. Sabia Konamaj.
Welcome back. You are still watching Nedbank Business Watch. And now for our market analysis, which is actually the final segment of the show, I am joined by Bongani Mabuza, who is the head of treasury at Nedbank Eswatini. Mshenga, thank you very much for your time. Let's start here. It's probably going to, dominate the conversation, but the story in Iran, we saw oil spiking at least above $110 per barrel on Monday, and now the price is back to under $90. Where might markets go from here?
Thank you, Natalie. It's a real pleasure to be here. Haven't been here in a while. Good afternoon to you and to your viewers. Yeah, I think you're spot on. What's really driving markets is the war in the Middle East, and we've seen that extend. It's now in the second week, and the real question around what happens to markets is really a question of how the extent of the conflict and how long the conflict lasts. So to your point around oil, you've seen oil spark to over 110. We're now at around $91 a barrel, which it's important to put everything into context, right? Mm-hmm. It's lower than than 110, but it is still 30% higher than where oil was 2 weeks ago. So that's the context that's important.
Can we pause him? Showing off been advised we'll have to go for an ad break. Nedbank Business Watch continues after this.
Digital helps you make cross-border payments. Human gives you global specialists. Digital allows you to apply for a loan anytime, anywhere. Human connects you to credit experts. Digital puts you in control of your money, while Human connects you to wealth advisors. Digital allows you to freeze, unfreeze, cancel, and reorder your card. Human gives you that personal touch. Digital when you want it. Human when you need it. Get the complete private banking experience with Nedbank Private Clients.
Those that are in pain must forget all the problems they have. Because the things of the earth have got no answer. But the answer that we have is all morning. When I'm preaching here, I'm preaching to myself. I receive the Holy Spirit.
I declare a turnaround is coming my way.
Turnaround is coming in my life.
Lalela sikutshele tindzaba letibuye enkosini. Uyezwa na uthokandaba luthango lonke laselibonjeni aluphelele ehlane esigodlweni ngalesihlanu lite nebugani bakhe mhlatili 13 kuyo indlovu lenkulu mhlatili 14 liyagidza libutho mhlatili 15 liyachithwa libutho usho njalo Mswati lomnyama kulabalithuli ulodungandaba sembelebelweni ulodungandaba semambondweni bayethe wena phakathi phezu komkhono ngekuthunywa ngawe emakhosi libutho lonke lwelithango kufanele silivunule lihiya leli-olinji ngemgcibelo bese ngelisonto livunula lihiya lelibovu luthango kelibheke ukuthi lonke luvunule kahle lube luhle luphindze lihloniphe bayethe wena waphakathi mswalo inkosi akayithathe akahambe nayo
Welcome back. Thank you for tuning in. We're still talking markets with Bongani Mabuza, who is the head of treasury at Nedbank Eswatini. Mr. Mabuza, glad to have you back in the studio. Where were we? Oh, yes. Oil at least $100 per barrel. Why is that so bad for the global economy?
No, thanks. Thanks again, Natil. I think we're talking about just putting the price of oil into context.
Yeah.
That we saw a peak of $110 a barrel. We're now down to around $91 a barrel, which is still higher than where we were. As I was saying, it's 30% higher than where we were 2 weeks ago. So it's still high. And what that means is that it is potentially inflationary if this goes on for long, if the conflict goes on for long, and you're unable to move oil through the Strait of Hormuz, which is the passageway through which about 20% of the world's oil moves. This is potentially inflationary since a lot of the global economy is heavily dependent on oil, whether it's through movement of goods, whether it's through movement of people, or it's through industry, which requires oil and oil products to function.
Right.
This leads to inflation, which leads to potentially higher interest rates.
Right. Looking at markets, I'd like for us to start with currencies. The dollar has been riding the wave, benefiting from this Iran conflict. What does this actually mean for countries that are oil import dependent?
Yeah, 100%. So what you see when there's uncertainty in the markets, and there's been no shortage of volatility, when there's large uncertainty, what investors tend to do is to fly to safety. The dollar as a reserve currency of the world is deemed as safe. So you've seen the emerging market currencies, including the Langeni, take a backseat, and you see stronger currencies benefit. I mean, today you are seeing the Langeni at 16.36 versus the dollar at 21.93 versus the British pound, and at 18.98 versus the euro, and that's just a function of that. You're seeing global investors fly to safety as a result of the conflict that's currently ongoing.
And moving on to commodities, gold has surged as investors hedge against the conflict in Iran. Bond yields also are fluctuating. Are investors moving towards commodities, safe haven commodities, and what does this say about global market risk appetite?
Yeah, 100%. I mean, if you have this much uncertainty as we have in the world now, it's the same theme. It's a flight to safety, and what that means in terms of commodities, you likely see commodities prices go up. In this case, the biggest beneficiary has been Brent crude, which is currently at $91 a barrel, as we have said. It's still higher than where we've seen it. It's down 2.9% today, but it's still much higher than where we've been in the past couple of weeks. Gold is up about 5 basis points to almost $5,200 per ounce. And what really that means is that gold, again, is a store of value, and wherever there's fears of inflation, fears of uncertainty in global markets, you will see investors fly to safe assets, including gold.
And when we move on to equities, what's your observation of how they are reacting to the war in the Middle East?
Yeah, so the same thing. I mean, as you rightfully said at the beginning, The conflict in the Middle East is driving all global markets. Equities are not an exception to this. There is a proposal that was made by the International Energy Agency yesterday, which is proposing to have the largest ever release of oil reserves in the world to ease the supply shock. So this has had an effect in terms of equities, particularly in the U.S. You saw energy stocks in the U.S. go down as a result, but this was not enough to sufficiently support the oil price. In the U.S., in terms of commodities, the S&P 500 was helped by Oracle, which was up 8% on the back of higher revenues from cloud. You also saw a number of other commodities support that. In China, for instance, Tencent was down as a result of proposals by the Chinese government to tighten regulations around the use of artificial intelligence by banks and financial services companies. So that tends to be the big driver of market is still the uncertainty that is created by the Middle East conflict. So there's generally a risk-off sentiment.
Thank you very much, Mr. Ngluza, for your time. That was Bongani Mabuza, Head of Treasury at Nedbank Eswatini, sharing insights on some of the latest in markets, actually. For now, this is the part where we wrap up the show. From myself and the team, thank you for your company. Take care.
Make better money choices. Choose a bank that takes your money seriously. Business Watch was brought to you by Nedbank.